Dennis, I do wonder if this is much more now a story about corporate fundamentals rather than the obsession that we've had for the past couple of years over what the Fed is going to do next.
Well, I do think corporate fundamentals are an underlying support for the market, but there is a particular problem as it relates to financial conditions right now that are impacting the market. We ultimately think it will be a short-term headwind in nature, but the fact of the matter is we started this year with economic growth outlooks from a consensus point of view about 1.3%. There was a very large consensus that thought there was going to be 6 cuts, which meant that inflation was going to be benign. And lo and behold, we ended up with much stronger economic growth than people were expecting. Atlanta Fed's GDP now casts at 2.9%, and inflation that's clearly sticky to the high side. So we're in a situation that was similar to 3Q last year, where financial conditions are tightening now, led by the U.S. Treasury yields, as you've seen, that will probably go to a point that make investors comfortable that there's less upside inflation and economic risk. And we don't have to worry about the Fed potentially even raising rates. And until we get through that process, again, a lot like we did in 3Q last year, until we get through that process, the market's probably going to struggle. So earnings, yes, they're a support, don't get me wrong. But we do have this little FCI tightening that's happening right now, which is complicating. And the way out of it is just lower inflation over time and investors getting comfortable with that outlook. They were very comfortable to start the year, less so now.
Do you have, I guess, any confidence, or are you seeing that confidence in the folks that you survey that we are going to maybe see that relief soon, meaning like maybe within the next 6 to 8 months?
Yeah, that's, I think, the issue is I think there was too much confidence in that. So there is a significant amount of confidence that you'll see some deceleration in inflation over time. I'd say it's 60-40, so that's a little bit harsh for me to say it's too much confidence. But yeah, I think most people are still set up for the idea that over the next year, you should see inflation on a core basis decline in a way that would be friendly for asset prices, meaning the Fed can continue or will, reduce rates in a way that they somehow get back to neutral. And any data point that questions that is an issue for the market. And most now being felt most definitely in, say, price momentum factor, which is coming under pressure today, which is NVIDIA and Netflix and the stuff that you already noted.
I know you don't talk about individual stocks. You mentioned earnings are a source of support, Dennis, except some of the high flyers are, giving less information about earnings. You look at Netflix yesterday saying that it's no longer going to give subscription numbers the way that it used to, following in Meta's footsteps. And we've seen how Apple in the past has stopped reporting sales of units of iPhones or iPads or Macs. What kind of statement does this send to investors in terms of the information that companies are willing to impart to the market?
Well, I'll use a little sell-side trick here. I think ultimately earnings are a support for the market over the course of this year. The problem with earnings season now is earnings expectations came in or inflected higher into earnings season. So the bar was high. Basically, since the Fed tightening program started, earnings expectations had collapsed into earnings seasons. And this was the first one we've seen basically in 2 years where you had this big lift. So it's not that earnings are necessarily poor. It's just that the expectations were very high going into this quarter. So in aggregate, earnings are strong. They're improving. You'll probably end up at 243 to 245 this year, which is great. That should support the market over time. Just that expectations were a little bit elevated in an environment where you have an inflation concern.
Right. I hear what you're saying about how expectations perhaps are a little bit stretched going into this earnings season. But the fact that companies are giving less information to investors who are desperate for evidence that their valuations are justified.
Yeah, it's a good point. I think leaning on company commentary about the future, certainly the macro backdrop is one of the worst things investors can do. Because when we've looked at this using a natural language processing tool, what they say about their own business is actually very positive and has consistently been positive. What they say about the outside world and the macro backdrop and inflation backdrop and uncertainty and every analyst on the street beating them up about the world is going to end, you've ended up with company commentary that has consistently been subdued. So I think it's just a little bit more being felt now because expectations were lifted going into the quarter. But I would fade this idea of like uncertainty and that being a signal because that has been really consistent and wrong, by the way, for the last 2 years.
I am curious about other signals, particularly when it comes to money flows, Dennis. There's been a lot made of some of the retrenchment that we've seen in equity markets, as well as this idea that you still have money markets that are still sitting near record levels, and a lot of other cash that certainly isn't being deployed to risk assets, if at all.
Yeah, I mean, I take a little, I understand that view. I just take a little bit of a more, and when you think about it this way, if money sitting in those assets is because interest rates are higher, because the nominal growth backdrop is better, right? And equilibrium interest rates have shifted higher, then your earnings growth over time should be significantly stronger. And if your earnings growth is significantly stronger than the cost of capital, which is the case right now for most of the S&P, then the market will be biased over time. Money will find its way into the market. So I fade the idea that there's like this lower return profile in equities relative to what you could get in cash. The reason cash rates are high is because demand growth and inflation as a result is a little bit higher than normal. So you're just kind of shifting up now with interest rates to just help keep inflation and demand growth in check. But ultimately, you're looking at a pretty good nominal growth / nominal earnings backdrop, enough to offset whatever you're going to be getting in a cash account.